Here's a question that probably doesn't keep you up at night, but maybe it should. Is your financial advisor actually working for you, or are they working for their commission? The answer comes down to one important word: fiduciary. And if you don't know what that means, you could be losing thousands of dollars without even realizing it. Welcome back to the channel. If you're new here, we break down complex financial concepts into plain English so you can make smarter money decisions. So stick around as we explore what a fiduciary advisor is, why it matters, and how to make sure your advisor has a legal obligation to put your interests first. Let's start with the basics. A fiduciary financial advisor is someone who has a legal and ethical duty to act in your best interest, not their own. Think of it like this. Imagine hiring a doctor. You'd expect that doctor to recommend the treatment that's best for your health, not the treatment that pays them the most commission. A fiduciary advisor is supposed to work the same way with your money. Now, here's where it gets interesting. Not all financial advisors are fiduciaries. This is a huge distinction that most people don't understand. Some advisors only have to meet what's called a suitability standard. That means they just need to recommend products that are suitable for you, but they don't have to recommend the best option. They can recommend something that's good enough for you, even if a better option exists, as long as they make a bigger commission on it. That's completely legal, but it's not always in your favor. Fiduciary advisors, on the other hand, are held to a higher standard. They must always recommend what's best for you, even if it means earning less commission themselves. It's a fundamental difference in who they're legally obligated to serve. So what types of advisors are fiduciaries? Registered investment advisors, or RIAs, are fiduciaries by law. They typically charge fees based on a percentage of your assets under management, often called AUM fees, usually between 0.5% and 1.5% annually. There's no commission on individual products, so their incentive is to grow your money because when your money grows, they earn more. Then you have fee-only advisors. These are advisors who charge flat fees, hourly rates, or retainers. They're typically fiduciaries, too, and they have zero incentive to steer you toward high-commission products because they don't earn commissions at all. On the other side, you have commission-based advisors and brokers. These people get paid when you buy or sell specific products, stocks, mutual funds, insurance products, and so on. Now, some of these advisors do operate as fiduciaries for certain types of accounts, like retirement accounts. But in other situations, they only have to meet the suitability standard. This creates a real conflict of interest that you need to be aware of. Why does this actually matter? Let me give you a concrete example. Let's say you want to invest in a mutual fund that tracks the S&P 500. A fiduciary advisor would recommend the lowest cost option available, maybe an index fund with a 0.03% expense ratio. But a commission-based advisor might recommend a managed fund that charges 1.2% annually because that fund pays them a commission, and the client doesn't immediately notice that higher cost being subtracted from their account. Over 30 years, that difference in fees could literally cost you hundreds of thousands of dollars in lost returns. That's not theoretical. That's real money leaving your pocket. So how do you know if your advisor is actually a fiduciary? First, ask directly. A real fiduciary will tell you proudly. Second, get it in writing. Ask for their fiduciary disclosure form or their ADV form, which financial advisors file with the SEC. Third, check the FINRA broker check database on finra.org to see if your advisor has any disciplinary history or complaints. Fourth, look at their fee structure. Fiduciaries typically charge transparent flat fees or AUM fees. They're not making money on commissions. Here's the thing, though. Being a fiduciary isn't always permanent or universal. Some advisors are fiduciaries only when they're managing retirement accounts like 401ks and IRAs, but not when they're managing regular investment accounts. That's why you have to dig deeper and ask the right questions. The bottom line? When you're hiring a financial advisor, fiduciary status should be one of your first questions. It's not a guarantee that they're good at their job, but it is a legal guarantee that they have to put your interests ahead of their own. In a world full of competing interests and hidden fees, that guarantee is worth a lot. If you found this helpful, please hit that like button and subscribe for more videos that break down confusing financial concepts. Drop a comment below with your biggest money question, and let me know if you've ever had an experience with an advisor that made you wonder if they were working for you or for their commission. I read every comment, and your question might be the topic of our next video. Thanks for watching, and remember, disclaimer, this is not financial advice. Always consult a licensed financial advisor before making any investment decisions.